want to get your initial reaction to perhaps not so much the 25 basis point hike, because that was pretty much expected, but the hawkish tilt from the FOMC and the expectation that there might be 4 hikes total through the end of this year.
Right. Well, you know, when you read the statement, the language, especially in the first paragraph where they describe the economic outlook for the next 3 years or so, lots more hawkish wordage in that language. But what was striking to me is when you go to the numbers, the projections that the various FOMC participants provided, really not much change at all from the last time they did a dot plot back in March. It's just not much changed. It's true that the sequence of dots there for the current year, 2018, now suggests they'll do 4 rather than 3. But that was really just the movement of 1 dot. And when you look out going forward at the projections, actually their projection for GDP growth really peaks in 2018.
Right.
Then there's a deceleration in 2019 and a further deceleration in 2020. The unemployment rate comes down a little more, so that's a little more robust. But, you know, the inflation rate is flat throughout this period. So really not much change in the numbers themselves. So, yeah, it is, I guess, a somewhat more hawkish tone overall, but especially when you look at the numbers, it's not a hugely more hawkish position in my view.
Yeah, the top lines that you went through, definitely just an uptick a little here, a little there. But one thing that Jay Powell himself said that he was puzzled, it is a bit of a puzzle, a quote, on wage growth. Why haven't those been rising, stuck at what, 2.7%-ish or so? Because that is an indicator possibly of rising higher. He's also talking about core PCE overshooting 2018, 19, and 20, 2.1%. But there's a disconnect here between both.
Well, that's true. Lots of things, lots of technical factors I think could affect that. But you know, the way I look at that is that the conundrum, if you want to use that term, is sure. Part of the broader picture of the fact that the Phillips curve, the so-called Phillips curve relationship between unemployment and the tightness in labor markets on the one hand, and the broader inflation rate, including not only wages but prices generally, just isn't working the way it did 20 years ago. It now appears that tight labor markets don't have the same kind of impact on inflation and inflation expectations as was the case back when I was working at the Fed. It is a bit of a curiosity. I would suggest the following as an explanation for that. When we were using the Phillips curve a lot in conducting monetary policy and making policy decisions, the Fed's credibility for keeping inflation down was much lower than it is now. And as we moved through the 1980s and 1990s, through the way we behaved, the way the Fed behaved, I think we built a lot of credibility for keeping inflation under control. And that's now built into expectations, I think, pretty strongly. And I believe that has a lot to do with the way this relationship is behaving now. And that's, I think, you know, a main reason why they're not expecting a big uptick in inflation. Of course, it could change. But for now, it's I think, part of a generally good overall outlook for the U.S. economy and for policy.
Al, do you think what Jay Powell said today, what the FOMC said in its policy statement, the general thrust of this, is consistent with all the comments that have been made about being willing to see inflation overshoot? A moderate overshoot is fine. It was below target. And with that, I'm going to pull up a GTV chart from our Bloomberg library, and you can. It basically shows that you got inflation at 2%. That's the target, and you've got the headline number just at 2% for a month, and you've got the core at 1.8. I mean, where's this sense of we're not worried about it? If anything, we're maybe a little more optimistic about the economy, and a little more willing to hike rates.
Well, you know, as far as the inflation is concerned, it's just. There's, I think, a main thing, Kathleen, that drives their projections for inflation is measures of expectations. In the past, the distant past, models of the inflation process, the way the inflation process was understood, we're not as dependent on expectations, but that's changed. So that's now part of the thought process that leads to inflation projections. And we just don't see much movement in longer-term inflation expectations, either the ones that are survey-based or the ones that are based on market data. I think that's part of it. And you know, I think what that means so far as policy is concerned, that will tend to restrain policy tightening, other things equal. One thing you mentioned, Chairman Powell's press conference, I watched that. He did emphasize the point that while we may, the Fed may be comfortable allowing inflation to go above its 2% target for a time, what will be a problem for them is if it persists. He didn't define persists precisely, but presumably that would mean, you know, if you began to see fairly significantly higher inflation, actual numbers, maybe 2-3 basis points above 2%, and they stay that way for a while, then I think that would get their attention, and that could then have an impact on policy. But if you get inflation maybe bouncing around the 2% rate, but moving back, you know, move up, move down, then I think the policy profile will stay the same. Excuse me, stay the same.
I want to ask you a very quick question. If you were at the Fed right now, would you be on the 4 rate hike camp or the 3 rate hike camp?
You know, I think I'd flip a coin, Kathleen. What I would be concerned about would be the projections for 2 or 3 years out in the future. And you know what they're saying, if you look at the projected median funds rate dot at the end of 2020, it doesn't change from the last meeting. It's a little above 3%, actually a little below 3.5%, and that would be the number. I would be mainly concerned about signaling, and I would be comfortable with that. Maybe I don't know. I might go for 4 just to build a little bit of insurance there, but it wouldn't be a matter of great importance to me.
And Al, we see this Fed funds rate now at 2.5%. We're inching quite close to the neutral rate right now. There's a lot of talk about whether the Fed can actually raise that Fed funds rate higher than that point. How much tolerance is there before we see any kind of disruption on the economy?
Well, you know, the projections that you see on the dot charts through 2020, the median there, as I said a minute ago, is slightly under 3.5%. I think today's estimate of the neutral rate is something like 3%. So, you know, I think in a way that leaves the story not completed. If to be consistent, that would imply that you get some backing down in the funds rate in the years, in the out years after 2020. But here, I think all of this always, as the chairman emphasized and always does in his press conferences and speeches, and others do as well, this is data-driven. This FOMC, and Kathleen, we remember how the FOMC behaved many years ago. It is very much data-driven. So if you begin to see economic numbers that suggest higher rates, I don't think there would be much hesitation in moving somewhat higher, but also if things move back in the other direction, you know, there's a lot of uncertainty. You have issues about trade. There are issues about possible problems in the European economy with the situation in Italy. In that circumstance, you could see that profile of further upward movements in the funds rate bent down somewhat as we go forward. A lot is going to depend on what we see as the remainder of 2018 unfolds.